Welcome to FinLoop. Today, we're going to talk about one of the greatest investors you've probably never even heard of. He's a Japanese maverick who built an absolute fortune, pretty much by breaking every rule in the book.
Okay, let's just cut right to the chase with the headline number. 9,300%. Yep, you heard that right. Over 25 years, his fund returned 9,300%. I mean, that is a performance that puts him right up there with the true legends of the investing world. So what does a number like 9,300% even look like? Well, take a look at this. This chart really puts it into perspective. The investor, a guy named Tatsuro Kiyohara, saw his fund compound at 20% a year, every single year. Now compare that to the entire Japanese market, which returned a measly 3% a year. He wasn't just beating the market, folks. He was playing a completely different game.
But here's the thing. This incredible success, it was anything but a smooth ride. In fact, his entire legacy was almost completely wiped out during one single brutal crash. And it's that moment that really shows you who the man behind the numbers truly was.
Check this out, -72%. This is the kind of number that would break almost anyone. At one point, his fund was down a massive 72%. Can you even imagine that? Watching nearly 3/4 of your client's money and your own money just evaporate? Most funds would have just shut down right then and there.
You know how he described this period? He said it was like being a sick patient getting hit by a car 3 times. I mean, what a quote. It was a total near-death experience, a crisis that just wouldn't let up and tested his conviction to the absolute breaking point.
So what do you do in that situation? Do you give up? Nope. He doubled down. In what has to be one of the most incredible acts of commitment I've ever heard of, Tatsuro Kiyohara poured pretty much his entire personal net worth into the fund. He was basically saying, I'm going down with this ship. He proved to his clients he had the ultimate skin in the game. And you know what? That one bet, it saved everything.
Okay, so that moment of crisis really forged the philosophy that powered his epic comeback. So the big question is, how did he do it? How did this guy find these hidden gems that absolutely nobody else could see? Well, his entire strategy really boils down to this one core idea: variant perception. It sounds fancy, but it's really just the art of seeing something that the rest of the market has completely missed. It means you have to find a view that goes against what everyone else believes. And of course, you have to be right about it.
So where did he find these unique insights? He found them in the dusty corners of the market that everyone else just ignored. His secret weapon? Hunting for these incredibly cheap, totally overlooked small and micro-cap companies. You know, the businesses that literally nobody was paying any attention to.
And this is where Kiyohara believed that individual investors, people like you and me, have a real edge. Think about it. Big companies are swarmed by analysts. Every bit of news is priced in within seconds. But these little small-cap stocks, they're often totally inefficient, completely ignored. If you're willing to roll up your sleeves and do the work, that's where you can find these massive, life-changing opportunities.
All right, so he's hunting for these tiny, overlooked companies. But what exactly was he looking for inside them? For him, it was simple. It all came down to one thing: the person sitting in the CEO's chair.
He truly believed that when you're investing in these small companies, analyzing the management is like 90% of the job. He was looking for leaders with this relentless mindset for growth and a super clear vision. He needed people who were impeccable with their word. You know, they actually did what they said they were going to do. And they had to be obsessed with building a wider and wider competitive advantage, a moat as the business grew.
And you know what? He wasn't looking for your standard, stuffy, buttoned-up executive. No, he actively searched for unique, outlier personalities, mavericks, people who saw the world differently. Although, as he found out, there's maybe a limit to just how strange they could be.
Okay, get ready for this. He once visited the founder of a beef bowl restaurant chain, and the very first thing he sees in the guy's office is a bench press. This CEO, who is apparently ripped like Popeye, spends the whole meeting explaining that Japan wouldn't have lost the war if its people had just eaten more beef bowls and bench pressed more. I am not making this up.
And it gets even weirder. When one of Kiyohara's own employees mentioned he goes to the gym, the CEO challenged him on the spot and hit him with a wrestling lariat. Now, the point wasn't to find professional wrestlers, obviously. It was to find these passionate, unconventional leaders who were just obsessed with winning. And guess what? It worked. That company became a massive, massive success. So, he's betting on these unique leaders in these tiny companies. You'd think he'd have some insanely complex spreadsheet to figure out what to pay, right? Nope, not at all.
His approach was, well, radically simple.
He just thought all those complex financial models were a complete waste of time. His starting point was super simple, almost like a rule of thumb. In a world with low interest rates, like Japan, any company trading for a price-to-earnings ratio under 10 was probably a bargain. I mean, you're paying less than 10 times its annual profit. Even if it never grew again, that's likely a pretty good deal.
But he had this really clever trick to find the true valuation. He called it the cash-neutral PE. And the idea is really simple. Let's say a company has a huge pile of cash just sitting on its balance sheet. Well, you should subtract that cash from its stock price to figure out what you're really paying for the actual business underneath. And when he did this simple adjustment, it revealed just how insanely cheap some of these companies actually were. And this really gets to the heart of his philosophy on risk. He believed that with these super cheap stocks, the biggest mistake you could make wasn't picking a loser. No. The real failure was getting stuck in analysis paralysis and missing out on a 10-bagger, a stock that goes up 10 times or more. For him, the cost of being too cautious was way, way bigger than the risk of being wrong. And that brings us to the final, and honestly, maybe the most profound lesson from his entire career. This is some wisdom that goes way beyond spreadsheets and gets right into the psychology of what it actually means to be a successful investor.
So, late in his career, he gets a meeting with the one and only George Soros. And during that conversation, Soros hits him with a question that just completely reframed how he thought about everything. About risk, about reward, about the whole game.
Soros looked at him and asked, "Do you want to make money, or do you want to leave a good track record? The two aren't the same." Just let that sink in. A good track record, what most people want, usually means smooth, steady, predictable returns. But making real money, I'm talking 90–300% kind of money, well, that requires taking huge, concentrated risks when you have that rare conviction. It means doing something crazy, like betting your entire net worth when you're already down 72%.
And that really brings us to the final question. And this one is for you to think about. Are you investing to truly win, to embrace the wild swings and take those big, concentrated bets when you see a once-in-a-lifetime opportunity? Or are you just playing to avoid losing, prioritizing a smooth ride over the chance for spectacular returns? The answer to that question really defines what kind of investor you are and what kind you could become. Subscribe to FinLoop for more short-form insights on finance, investing, and global markets.